Everyone, welcome to our morning classes. Maybe for a few very early morning classes, and maybe for a few good time classes. But, anyways, wherever you are and whenever you are watching this, students, it is very important in studies, that is continuity. Now, just 2 days back, we had a super CA final results. Very soon, we are expecting our CA inter results. And if you observe the pattern, you will find that the students who have been committedly working, who have been very focused, very strategized in their study plans, very disciplined in their execution plans, and most important, at the time of exams, you may face one or two paper, maybe in each group one paper, which you feel is beyond your capability, which you feel is in your language very tough. Some people even say out of syllabus. Let me tell you, for CA, there is no syllabus. If tax is a subject, then anything under the sun can be asked, because anything under the sun you'll have to face in the real life. Similarly is financial management, similarly is accounting, similarly is costing, law, anything. So there is nothing like out of syllabus. It is just shortfall of preparation. But still, what is very important, students, if you observe in the exam results, is that if you have been able to overcome those 15 minutes of exams where, as you read the paper, you were taken back, you were shocked, or for the time being you felt that this attempt is lost, but still you recovered from that shock. You gathered all your patience, all your confidence, and you attempted the paper. Those students have passed. So, what I am trying to tell you, students, is that two things will decide your result. First, your disciplined, scheduled, strategized preparation, your disciplined hard work, your scheduled execution of all your plans, wherever required, modifying the plans. And then the second most important thing is those 3 hour 15 minutes. 15 minutes where you get the paper early for reading, and then the 3 hours for writing. Students, you have to master both. And let me tell you, this is what exactly the life will be demanding from you when you step into this commercial world as a professional. One, committed, dedicated study and upgradation of yourself, because we are in the field of knowledge. And as you know, regularly laws are changing, regularly new technologies, new techniques, new concepts are being developed, are being adopted in various fields. So, regular discipline updation, and when it comes to execution, being composed, being what do you say, having a strong belief in your preparations, your concepts, and at the time of execution, having faith in the Almighty that yes, I have prepared, let me give my best attempt, let the result be up to Almighty. When you have these things in mind, students, I tell you, you will have the best of results, whether it is your academic exams, whether it is your professional life, or anything you do in your life. Fine, students. And let me tell you, the best part of our CA course is it teaches you life. I always tell my students, CA course is not about costing, auditing, or taxation, or accounts, or FM only. It is about life. It is about developing yourself, preparing yourself, making yourself ready for life. That is the best part of the CA curriculum. When I look at my 4 years of CA, before those 4 years and after those 4 years, What changed was not only that I was qualified having a degree, but what changed was my whole self. And that is what decides your entire career and your life path. So, students, with this, let me start. We are in the very beautiful, if I can use this word, topic of capital gains. Why I call it as beautiful? Because truly, this topic enriches you so much. Till now, you were not having knowledge much about compulsory acquisition. You never thought there could be conversion of asset into stock in trade and where the asset is still with you, but you have done something which is called as conversion. You are not knowing that in housing societies, you actually do not uh, legally own your flat. You are only a shareholder, and your flat, whenever you are selling or buying, is not actually sold or bought on paper. What is sold or bought is only the share in that society. Then you also came across concepts relating to amalgamation demerger, that okay, such type of things will happen in amalgamation demerger. You came to know something new about gold deposit receipts and so many things. Then, if you remember our last discussion where somebody had asked question on why gold and silver utensils are having a different treatment, then we went into some very interesting discussions, very crucial discussions. Maybe it may not affect or impact your inter exams, but definitely it has a direct bearing on your final exams. So, students, this is why I call this subject, this chapter especially, very beautiful, because you get to learn so many important concepts. You come to know so many important things, how transactions, how transfers, how businesses operate. Now, we have reached to a stage in this topic where today we will be landing on the calculations, right? But before that, I once again welcome all of you all. Very good morning, everyone present. Good morning, Dhanlakshmi, Sridhar, Akash, Krishna, Anjal, everybody. There are few questions. So Krishna says, sir, in paper of law, it is difficult to remember word by word. See, firstly, as far as I understand, Krishna, there is no need to learn word by word. Please keep this in mind. You need to know the provision, and you need to be able to write it correctly, and wherever you have a case study question, apply it correctly. There is no requirement that you have to reproduce the exact language of the law verbatim, not required. So, no need to try to learn or remember it word by word. Yes, if you can remember the law in its own language, that's great, but that is not a compulsion for writing the paper. Let me make this very clear. Yes, section numbers you need to learn, but exact the legal language or the language of the provision with all commas, apostrophes, not required. Next is question of Anchal. She says, sir, how to make notes? Because whenever I open a book for preparing notes, I find each word is important. Great. So Anchal, if you have observed our lectures, you will find that two major topics of not only income tax, but you can say out of your entire syllabus of inters, you will find that there are different subjects in which there are some lengthy topics. And if you put all these subjects, lengthy topics together, definitely PGBP and capital gain will have a higher weightage in terms of its length. But still, if you see, my PGBP notes are converted into some 8 to 10 pages, and my capital gain notes, which I'm writing along with you, will be hardly 5 to 6 pages. What is important is, Anchal, no problem. Even if you feel that every word is important, firstly, notes taking means concising the content and putting one word or one sentence which will help you recall that entire content. And then maybe you can give over there the reference of the respective module page number. So, what I mean to say, let us say we are discussing transfer and not transfer. I have written one word, and you may write the page number from module where from you have studied that, so that whenever you are revising, if from those one words you are not able to recall, go back to module. Now in module you should underline, you should do highlighting. That you can do lengthy, that is many parts you can highlight, you can mark the whole box. But when you are writing down something, try to make it short, one word, one line, and use whatever word line you feel will help you recall the point, right? Harshal says, good morning. Yes, good morning, Harshal. Kambira says, sir, I am doing illustrations in notes and golden rules for this subject. Great. That's really great. And Krishna says, your notes are helpful. I have, in accordance with your notes, made brief notes. Very good, Beta. Great. Okay. So, students, let us come back. So, today we will be using this format, which is the format for computing capital gains. But as you remember, before you land to the format, you need to first answer few questions. First, did you have a capital asset? Was the capital asset transfer? Now, while answering both, you know there are exceptions. So your asset should be an asset which is taxable asset, means excluding the exceptions. Your transfer should be a taxable transfer, means excluding those cases which is not transfer, right? As you can see here. Then within assets, you have type. Now, this type of asset has some bearing on calculation. So type of assets are long term. Long term is simple, defined as asset which is not short term, and then short term, which is defined on the basis of period of holding. So basic rule is there are two periods of holding. One is 12 months, 24 months. Then there are exceptions where for a few assets, they have said we will not see period of holding. The gain or loss arising from them will be treated as short term. And then there is one case where I believe that here the law, while making amendment, they made amendment in the main provision, but where independently this section was written, that is slum sale is written independently again in 50B, there they missed to make the amendment. So I'm expecting that very soon this 36 months rule for slum sale will be changed to 24, but until then we follow the 36 months rule. So that also becomes an exception because there is only one case where 36 months rule is applicable. Now, once you cross the barrier that whether there is asset or not, yes, whether the asset is transfer, yes, then comes the next question. Is your case exempt under section 10? The answer to this should be no. There are only two cases applicable to us which are exempt, and that I'll explain you because those are very one-off cases. So not required now. That can be taken off later. Then once you cross these three barriers that yes, I have asset is transfer and both are taxable cases, and my case is not exempt under section 10. Then comes the point that now I have to do computation. And in computation, the first thing that you have to decide that it will be taxable in which year. What is the year of chargeability? Now, this is very important in capital gain because capital gain does not arise every year. So it is not like a running income which you get from salary, house rent, or business. This may be one-off incomes. So it is very important in which year it is taxed. The law says it is taxed on accrual basis. What is accrual? Whether or not you have received the money, we will tax it in the year in which capital gains transfer has taken place. So the year in which the transfer took place, that becomes the year of chargeability. Now, obviously, this will have exception where it will not be on accrual basis, it may be on receipt basis. That we will study as we proceed. And then we come to computation. In computation, you require full value of consideration. So which is general rule is the money, or if you are receiving any asset, the FMV of the asset received, and all this money FMV will be considered as full value only if it is received against the transfer of the asset. So whatever asset you transferred, on transfer of that asset, if you are paid something as a consideration, which may be monetary form or non-monetary form, that will be regarded as FVC. Then comes what will be cost of acquisition of your asset. Again, the general rule is cost of acquisition is cost as per your accounting concept. Now, in accounts, how do you find out cost of any capital asset? It is the purchase cost, purchase or construction, plus all expenses that you have incurred until the asset becomes ready for use or the asset is put to use. Right? Then there are exceptions, very important. Your cost is the cost at which the previous owner had purchased the asset. When this applies, I have put it in the form of golden rule. Then second exception is that in some cases where at the time of receiving the asset, it was taxed under salary head or HP head or PGBP head or other sources head, then whatever amount or value was considered for computing your income under that other head, that will be considered as cost of acquisition, that I have put as golden rule A. And then for intangible assets, if you have purchased the intangible asset, it is your actual cost of purchase. So it is same like your general rule. But if it is self-generated, like in case of goodwill, the most common example, though intangible assets will cover everything, goodwill of business, profession, it will cover all types of patents, copyright, trademarks, all types of intangibles, what we know. So if it is self-generated means that you have not purchased it. Automatically, it became an asset over a period of time. Like how if you run a business for 15, 20 years, there is a goodwill of the business, which you can then sell to someone, which is self-generated. Then the losses, you will take the cost as zero. Then few more special cases where you are originally a shareholder of a company and now the company wants to issue new shares, it has to first offer the shares to you. That is the existing shareholder. This is called as rights to purchase the shares. Not right shares, right to purchase. Now, in accounts, you would have studied this, that either I can use these rights and purchase the right shares, or I can simply renounce these rights, sell off these rights to someone. Now, when I'm selling off these rights, then the asset which I'm selling off is the right, which is again an intangible asset. And this same rule applies. I got this right free of cost because I was originally a shareholder. So for me, the cost of purchase is nil. Company issues bonus shares to its shareholders, which is a different way of rewarding them or repaying them. Now, these bonus shares, the first point is the cost is taken as nil. Now, there are few more pointers in cost of acquisition. We'll cover that today. We'll cover few cases of full value of consideration, and then we'll proceed to solving our sums. Yesterday night, I have uploaded the practicals on our portal, the practical question set. So you may please download it. Then besides cost of acquisition, the another cost that has to be subtracted is cost of improvement. In cost of improvement, what you cover is nothing but after the asset is purchased, if after that in any future year you incur a capital expenditure, that capital expenditure is cost of improvement. Besides this, if you see the format, there is one more item which is expenses on transfer. So expenses on transfer is basically those expenses that you require to incur so that you could transfer or sell your asset. Now it will include agent's commission, advertisement, any type of legal expenses, registration expenses. However, what cannot be subtracted is if you have sold shares through stock exchange, the stock exchange has charged you STT. That cannot be deducted. That is an exception. One more important point in computation is if your asset is long term, for long term assets, the cost of acquisition and cost of improvement has a star, which says that in case the asset is long term, you should inflate the cost to bring that old cost to the present money value. This is called as indexation, which means inflating the cost of acquisition or cost of improvement of the past year to bring it to the money value of today. However, if you remember, we had discussed this in detail. As on date, indexation is not applicable to the computation. As on date means for the financial year 25-26. Rule is now you are not going to do indexation. So when you are computing capital gain, you will not do indexation for any asset, for any assessee. Yes, when we will study the computation of tax, at the time of computing the tax, at that time, there is an option given to individuals HUF that if what they have sold is a long-term land or long-term building, they can compute the tax by two methods. One is without indexing, which they have already done in computation, find out the tax at a lower rate. Second, after indexing, find out the capital gain and find out the tax at a higher rate. Compare both the tax and pay the tax whichever is lower. So this comparison is only for the tax portion. Computation of capital gain will always be only by one method, that is without indexing. Okay, Arun Sagar is having a question. sir, if I had 100 equity shares and later on the company gave me further 100 shares as bonus, so now I have 200 shares. And now if the question says 50 equity shares are sold, so how should I find the cost of acquisition? Arun, let me tell you one thing. If your shares are held physically, now there are two possibilities. You are holding the shares physically or you are holding the shares electronically, which is in demat form. If your shares are physical, then you very well know that these 50 shares are which shares which are sold, which means the original one which you had purchased or the bonus one which you had received free. Now, if it belongs to the original set of shares, you will take the cost of acquisition of original shares. If it belongs to bonus shares, so till now we have studied one cost of acquisition for bonus shares. Second, we are going to study in few minutes. So the first cost of acquisition of bonus shares, it is nil. So if your shares are physical, you very well know which shares are sold. So you will be simply taking that cost of acquisition and not averaging it out. First point. Second point, if your shares are held in demat form, that is in electronic form, not in physical form, the law says you will take the cost of acquisition following FIFO. What it means? That whichever shares are demat first, you will assume you have sold those shares first. That is first in, first out. So Arun, wherever shares are held in FIFO, in demat form, you follow FIFO. Students, please mark these small pointers like I'm answering it on the basis of someone's question. So with question answer, you will understand the provision much faster, much easier. So whenever someone is asking a question, kindly uh, follow that so that you will be able to understand it much better, right? What happened? Yeah. Any further questions, students? No. So now let me take you to the next part of provisions. So we were discussing cost of acquisition. We were here. So we completed cost of acquisition up to this point in the last class. We studied cost of acquisition up to this point. If you remember, I have for the time being kept this outside. Why? Because it is a very specific case covered under 112 and where your shares are acquired before this date. So it is a very specific case. We'll cover it separately. Don't worry for that. Because if I start taking everything at one go, it may be difficult for you to understand and digest. So let me, for the time being, keep this part aside and let me start from here. Now, we are dealing with cost of acquisition in different cases, and this is a very important case. Now, if you remember in the last class, we were discussing this point, though I had said that we'll understand this in detail. What is this point? What if your asset is very old, which is a possibility, right? You may have purchased the asset and the asset is purchased long time back. Now, when the asset is purchased long time back, there is a challenge. What is the challenge? One, you may actually do not know the cost of acquisition, or you may not have valid proof of the cost of acquisition. Now, when this particular situation came to the knowledge of the tax authorities and the legislature, they decided to make a provision to cater to this. Now, what is that provision? That provision is this particular point. What this point says, where your capital asset was acquired before 1st April 2001. So this is that cutoff date, you can say, the lawmakers have kept, that your cost of acquisition, sorry, your asset is acquired before 1st April 2001. Now, when your asset is acquired before 1st April 2001, the law gives you an option to take the cost of acquisition as either your actual cost or the FMV of the asset on this date, whichever you feel you want to take. Now, obviously, when we are talking about cost of acquisition, and if I'm given an option or choice, which cost I will prefer, definitely I'll prefer the cost whichever is higher. So even though the law has not written that, it is saying you can take any of the two costs at your option. Logically, you will be taking the one whichever is higher, because if I'm taking a higher cost, to that extent my capital gain and eventually my tax will be lower, right? Now, every rule has an exception. So this also has an exception. Already this cost of acquisition is part of our exceptional cases, because a normal rule of cost of acquisition is cost of acquisition means actual cost. So firstly, this provision itself is an exception. And within this provision, there is one more exception. Now, firstly, what this provision says, if your asset is acquired before this date, what cost you should take? The law says either the actual cost or the FMV on this date. At your option, I am saying whichever is higher. So we'll write it as whichever is higher only, though the law says at your option. Now, if this asset, which is purchased before this date, is a land or a building or both, then before you take whichever is higher, that is cost of acquisition and FMV, whichever is higher, you have to compare the FMV with the stamp duty value. And you have to ensure that the FMV does not exceeds the stamp duty value. So effectively for land and building, it will be your actual cost of acquisition compared with what? FMV or stamp duty value, both on 1st April 2001. Now, firstly, out of both these, you will take whichever is lower. So FMV or stamp duty value, whichever is lower, you will take that value, compare it with actual cost. Out of both these, whichever is higher. Because anyways, our rule was this only, that you will take actual cost of acquisition or FMV on 1st April 2001, whichever is higher. Correct? So original rule follows that you have to take out of the values whichever is higher. So one value is cost of acquisition, and in the second value, you will first make a separate calculation. What is that separate calculation? You will take the FMV on 1st April 2001, compare it with stamp duty value on 1st April 2001, first take whichever is lower. So out of both these value, whichever is lower, compared with the actual cost of acquisition, whichever is higher. So this becomes our special case of cost of acquisition. So here we were writing cost of acquisition. Now to that, I will add one more case. Now see, all these are under 55(2), and then there are subclause, etc. Asset acquired before 1st April 2001. What is the rule? Your cost of acquisition will be actual cost of acquisition compared with stamp duty, out of this, whichever is higher, right? But if your asset is land or building or both, it will be actual cost of acquisition compared with FMV or stamp duty value. First, you have to take out of both whichever is lower, and then comparing both these, whichever is higher. Again, these both values are to be taken as on 1st April 2001. Which value, FMV or stamp duty value? Compare both of them. Whichever is lower is this value, and comparing this lower value with actual cost of acquisition, whichever is higher. So this is another special case of cost of acquisition where you are taking cost of acquisition as a different figure, different from your actual cost of acquisition. Now, interestingly, this rule applies in both cases. First, it applies if you have purchased the asset. It also applies where your cost of acquisition is cost of acquisition of previous owner. That is first case. So what this point means? So first possibility, you have purchased the asset before this date, you follow this rule. Second possibility is you are taking cost of acquisition of previous owner as your cost. Why? Because the asset was acquired by you, received by you as gift, will, inheritance, amalgamation, holding subsidiary, any of those cases which is not a transfer. Now, in all those cases, in our golden rule B, we have seen your cost of acquisition is equal to what? Cost of previous owner. Now, what if the previous owner has acquired this before 2001? So same rule. You will take the actual cost of previous owner because that is what you are going to take as your cost. Take that cost and first compare that cost with FMV on 1st April 2001. So this rule applies in both cases, whether the asset is purchased by you or whether it is purchased by previous owner and you are taking cost of previous owner. So whoever cost, you have to take your own cost or the cost of previous owner. Whatever you have to take, that cost compared with 1st April 2001's FMV, whichever is higher, will be the final cost of acquisition. Is this clear to all students? Anybody, any questions or doubts? Yes. Students, anybody, any doubts? Anchal is asking, sir, cost of acquisition means what? Huh? Anchal, what are you asking? You forgot everything. In the first class, I said while computing capital gain, we are having four figures, full value, expenses, cost. In this, what is cost of acquisition? We have been discussing it in every class. It is the cost at which you purchase an asset or you construct an asset. Cost of acquisition in very simple word means your purchase cost, construction cost. So why that is a confusion, Anchal? Means why suddenly you're asking me cost of acquisition means what? I did not get it. In every class, we are discussing this word cost of acquisition. Right? Everyone clear? So this is the main provision. And what I also explained that this also applies where capital asset became the property under one of the modes, which is not a transfer, in which case you have to take your cost as the cost of previous owner. In such cases, if the previous owner had purchased this before 2001, you apply the same rule. You take the actual cost of previous owner, compare it with FMV of 1st April 2001, whichever is higher is your answer. Right, students? Harshal, what is this ACOA? What is ACOA? Huh. You're asking me or you're telling me? I'm not getting it. So what do you want to ask? I'm not getting your question. Yes, tell me.
सर अगर जो अभी आपने बोला, पहले हम कॉस्ट ऑफ एक्विजिशन ऑफ द एसेट्स आरसीसी और द एफएम वैल्यू ऑन द डेट ऑफ 1 अप्रैल 2001 में विच एवर इज हायर लेते हैं, तो इन
हम्म
दैट केस सर हमने लोअर वैल्यू लिया तो
तो मतलब
जैसे अभी इधर केस जाए कि 1,40,000 है और 30,000 है, तो हमने 1,40,000 लेना है एज ए एफ एम
हम्म
ऑन दैट डेट। तो अगर हमने 30,000 लिया तो इन शॉर्ट जो हाउएवर है, बाद में जो बोला है कि एफ एम और एस डी बी वैल्यू हम कंपेयर कर दे लोअर, और एक्चुअल कॉस्ट को कंपेयर करके हायर लेते हैं, तो इन
हम्म
रिजल्ट वैल्यू 1,40,000 आएंगे ना, गिवन एग्जांपल्स में जो मॉडल में दिया है, पेज नंबर थ्री
बेटा
फोर वन
मुझे नहीं मालूम आप मॉड्यूल में कौन सा एग्जाम्पल देख रहे हो, बट मुझे नहीं समझा आपको अभी भी क्या डाउट है इधर। सिंपल स्ट्रेट फॉरवर्ड क्वेश्चन है ना बेटा, कौन सा एग्जाम्पल की आप बात कर रहे हो, ये वाला?
हाँ, मतलब फर्स्ट और सेकंड को मिला के मैं बोल रहा हूँ, मतलब फर्स्ट में 30,000 है एक्चुअल ओनर की कॉस्ट, और एफ एम ऑन दैट 1,40,000।
बराबर। फिर
मतलब मेरा कहना था, जो अभी सेकंड एग्जांपल है, इन शॉर्ट 1,20,000 ही वैल्यू रहेगा ना एच डी में।
करेक्ट बेटा, तो अभी वही तो अपन ने समझा। आप एक काम करो ना, मैंने ये जो ड्रॉ करके दिया आप इसके सामने वैल्यू लिखो ना। इधर क्या लिखोगे आप? 30,000। इधर क्या
30,000
लिखोगे? 120। इधर क्या लिखोगे? 140। सॉरी,
वन,
उल्टा।
हाँ एच डी में 1,20,000 रहेगा, एफ
हाँ,
एम में।
लिखा आपने। अब मैंने जो
हाँ,
यहाँ पे लिखा है सिंपली उसको फॉलो करो, इन दोनों को कंपेयर करो, दोनों में से कौन सा लेना है, विच एवर इज लोअर। तो कौन है लोअर? ये।
1,20,000।
और फिर अब इन दोनों को कंपेयर करो, इसको और विच एवर इज लोअर वाले को। अब इन दोनों में से कौन सा लेना है, विच एवर इज हायर।
1,20,000 इज द वैल्यू ऑफ
खत्म।
कॉस्ट।
तो मैंने आपको फॉर्मूला बना के दिया ना बेटा, उसमें डाउट क्या है? आप फॉर्मूला में फिल इन द ब्लैंक्स करो, आपको आंसर आ जाएगा।
ओके सर।
हाँ, मुझे नहीं समझा आपका क्वेश्चन पूछने का रीजन क्या था। मतलब मैंने सिंपल फॉर्मूला बना के दिया, आप फॉर्मूला फॉलो करो, यूल गेट द आंसर।
ओके सर।
तो सेम पॉइंट कि अगर you have to take cost of acquisition of previous owner because you had acquired the asset in one of the cases which is not transfer, the same rule will apply. You will take the actual cost of previous owner, compare it with 1st April 2001's value, whichever is higher is your answer. Next special case. Now this may not be very required or useful to us in exams, but we can just study because it is part of the module. Where capital asset became property of the assessee on distribution of capital asset and the assessee has been assessed to capital gains in respect of asset under 46. Now see, अगर आप देखोगे तो ये हमारा गोल्डन रूल ए फॉलो कर रहा है. What is this golden rule A? That the assessee received some property. आपको प्रॉपर्टी मिली कब? जब कंपनी ने वो डिस्ट्रीब्यूट की थी. So you receive the capital asset at the time of distribution and it was already assessed to tax. उस पे आप ऑलरेडी टैक्स भर चुके हो अंडर सेक्शन 46. अपना रूल क्या है? whenever you receive an asset, if at the time of receiving the asset it has become taxable, then what is your cost of acquisition? Your cost of acquisition is the value which will be taken for the purpose of computing your tax on that day. So same point is given over here. When you are receiving asset from a company and it has been taxed, so what value is taxed? That value becomes your cost. So that is what is the simple point. Next, share or stock of a company may become the property of the assessee in one of the following cases. In all these cases, if you see, these are all the cases which are not regarded as transfer. Then what will be the cost of acquisition? Cost of acquisition will be calculated with reference to the cost of acquisition of your previous asset. Again, this is golden rule B. If you are receiving any asset in one of the ways which is not a transfer, your cost is cost of previous asset. So see, all these are repetitions. That is why we call it them as golden rule, because they cover so many different cases. Then We come to the point of intangible assets. So intangible assets has so many types of intangible assets. Self-generated nil. If it is purchased, then actual purchase price, right? Now in this, there are some special pointers. However, in case capital asset is goodwill of a business and in respect of which you have claimed depreciation. Now, simple logic, if you are selling anything which is a depreciable asset on which depreciation is claimed, what is your actual cost? Actual cost will be your actual cost minus depreciation. Again, this is logical. So I had purchased the asset for 100, but over a period I have taken depreciation of 40. So obviously the actual cost will be 60. Then it became the property of the assessee by way of distribution of asset on partition of HF or gift will, right? By succession, inheritance, or distribution of asset of the company, etc. And the previous owner had acquired it by purchase. Then price of previous owner. Golden rule B. So all these cases are not transfer cases. Partition of HF, gift, will. When you have received asset in one of the ways which is not a transfer, your cost is cost of previous owner. Again, same point. If previous owner has claimed depreciation, then what will be your cost? Price of previous owner minus depreciation. So see what has happened. Again, they are repeating the same provisions. It is nothing new. It is nothing different. We have already studied that above and also have created a golden rule. You just follow the golden rule. Now we come to the bonus share point. Now this was already covered above, but we had covered only one of the situations. What is that situation? Bonus shares were given to you after this date. Then the cost is nil. What if bonus shares are given to you before this date? Now, interestingly, if bonus shares are given to you before this date, now we already studied this rule today. What will be the cost of asset? It is your actual cost or FMV on 1st April 2001, whichever is higher. Actual cost is nil. Why? Because you have received the asset free. So nil or FMV, whichever is higher. Obviously, what will be the answer? FMV. So that is why I had kept this point blank yesterday, because till yesterday I have not explained you the point of 2001. So now we can add here that if bonus shares are acquired before April 2001, what will be the cost of acquisition? It will be FMV on 1st April 2001. Why? Because of this rule. So this is not a rule of bonus share. Bonus shares rule is only one, nil. But if bonus shares are acquired before 2001, you apply this rule. And in this rule, nil compared with FMV, obviously whichever is higher is FMV. So by default, because of this second rule which we studied today, the cost of acquisition of these bonus shares will become your FMV on 1st April 2001. Clear, students? Understood by all? This point, if you remember, for shares, I have left one point. So let me keep it aside because we'll study it separately. We'll first solve sums on other type of cases and then we'll come back to this. So again, bonus shares which are allotted before this date. So if you remember, I have left out one point above, that where shares are purchased before 1st February 2018 and STT has been paid. So this case we are keeping aside for the time being. We will discuss this, understand this separately, right? Then for right shares, firstly, in right shares, you first have original shares. What is the cost? It is the actual price. Then you get the rights to purchase the shares. Rights are intangible assets. So apply the rule of intangible assets since it is a self-generated right, nil. If you purchase the right shares by using the rights, then again it is the price which you pay. And last possibility, right shares. Actually, you got the rights, but you do not want to purchase the shares. So you sell the rights to me. Now, when I am purchasing the right from you and then purchasing the right shares, I have paid for two things. Firstly, I have paid price to you for the rights, and then I have paid price to the company for the shares. So my cost is addition of both. One is the price paid for the rights plus the amount paid for the right shares. So for me, the right shares cost is addition of both. All this we discussed in the previous class. Again, this point is left out. Shares acquired before 1st February 2018 and at the time of purchase and transfer you have paid STT. This is a special case. So we have just kept this pending. All others are completed. Again, this point we just completed. This was the new point today. Asset became your property before 1st April 2001. So it is actual cost or FMV as on 2001, whichever is higher. Law says at the option of the assessee. Again, I repeat, you can take lower also. But tell me logically, as a student of commerce, if you take lower of the two values, it will be your own loss because we are talking about cost of acquisition. Lower cost means higher capital gains, means higher tax. So why will you take lower? You have to take higher. Though the law has given you options, so the law has kept it to your wisdom. So we also have to act wisely. We'll take the higher of the two. Next, capital asset being land building, FMV as on this date shall not exceed stamp value. So wherever the capital asset which is acquired before 2001 is land building, then before you compare actual cost with FMV, first compare FMV with stamp value, take whichever is lower. And then this lower amount compared with actual value, whichever is higher. And last point is where this capital asset was acquired by the previous owner and you got the capital asset in one of the votes, which is not a transfer like gift, partition of HUF in all these cases, succession, inheritance. In all these cases, for you, the cost is cost of previous owner. And since previous owner has acquired it before 2000, apply the same rule, take the cost of previous owner, compare it with FMV. If it is land building, compare first FMV with stamp duty value. So same thing what you do for your own asset, you do for the asset of uh, company. Sorry, asset of previous owner. Next. Now this point, if you remember, I had explained it in the previous class. When somebody was asking me, when we were discussing the rule of previous owner in the previous class, then somebody has asked me, sir, what if the previous owner's cost is not known? Then I had said that if the cost of acquisition of previous owner is not known, what is the rule? You take the FMV of the asset in the year of acquisition. That is what is this point, where cost of property in the hands of previous owner cannot be ascertained. So what if you do not know the actual cost of previous owner? You have to take cost of previous owner, but that itself is not known. Then you take FMV of which date? The date on which the previous owner had purchased the asset. Correct, students? So this also we discussed in the previous class when I was answering somebody's question, right? Anil is asking, sir, could you please guide us how to handle situations like securities in foreign market, which exchange rate needs to be used? Definitely, Anil. We will be getting that point. Once I reach to that point, I'll definitely explain. But please understand and appreciate, Anil. What you are asking is not a regular situation. It is a very special situation, right? So how I'm explaining you all, I'm first covering those situations which are 80% cases of your paper also and in real life also. Because those are the ones which will come in every question. Let us first complete them. Then we'll go to remaining 20%. Like I have left one point of shares, right? What is that shares point if you remember? Where shares are purchased before 1st February 18, STT paid. I have not covered that. Similarly, this question which you are asking, that securities in foreign market, exchange rate, we will be covering that. Don't worry. But right now, let us first start solving sums and making our 80% portion intact. Then definitely we have so many special situations which we have to definitely study and understand, right? Now coming to cost of improvement. Now, let me come back to our notes because this I'm sure will be more helpful to you. Now, what is the general rule? Cost of improvement is what? Capital expenses which are incurred after the purchase of the asset, that is after the acquisition. So you have incurred this capital expenditure in future years. Future means after the purchase. And this leads to increase in the value, obviously. So if you add few floors to the building, that will lead to increase in the value. So whatever capital expenditure you incur in future, that is called as cost of improvement. Simple and logical. So in short, While computing capital gain, let us say I had purchased a building. Originally, this building had 3 floors when I purchased it. So the purchase price of this building of the 3 floors is cost of acquisition. Then later on in future, I construct 2 more floors after 4 5 years. Then this 2 new floors which I have constructed is my cost of improvement. Now today when I sell this complete building, I'm selling 5 floors. So logically, I am receiving the price for 5 floors. So I should also reduce the cost of 5 floors. How I will reduce? Cost of 3 floors will be reduced by the name cost of acquisition. Cost of 2 floors will be reduced by the name cost of improvement. Correct? Is this fine? Is this understood? Yes, Dhanlakshmi, you're right, beta. Good logic. You're right. Now, so student, this is FMV, sorry, cost of acquisition, cost of improvement, general rule. Now again, for every rule there has to be exception. So we are coming to exceptions. What does exception says? Cost of improvement shall be ignored. That is taken as nil. So you will not consider cost of improvement. You can say it this way, or you can say that you will take it as nil. It means nothing will be subtracted. In short, we are now talking about these 2 floors cost. Now in this, when cost of improvement should be ignored. So case 1, intangible assets. For all intangible assets, cost of improvement will not be considered, or in other words, it will be taken as nil. For all tangible assets, cost of improvement before 1st April 2001. This has to be taken as nil. This has to be ignored. Now, these are the exceptions where we are not following our own rule. What is our rule? That whenever in subsequent years you have incurred any capital expenditure on your asset, that capital expenditure should be considered as cost of improvement and it should be subtracted while computing capital gain. And I've already explained you the logic in the form of that small diagram. Logically, if you are getting the price of 5 floors, you should subtract the cost of 5 floors. Now comes the point, then why this exception? Because in these exception cases, they are saying in these 2 cases, you will not subtract the cost of improvement. Why? Because it will be taken as nil. Now you'll say, sir, what is the logic? Because I have always been telling, understand provisions with logic, the logic with which they are made. If you study it that way, remembering them will be very, very easy. Now, what is the point? The point is, first is intangible assets. So for intangible assets, we say, take cost of improvement as nil. That is, don't subtract anything as cost of improvement. Why? So for this, if I have to explain you the logic, let me take you to the rule of cost of acquisition. For intangible assets, what was cost of acquisition? If it is purchase, actual cost. If it is self-generated, nil. Now understand one thing. Once I have purchased a goodwill, so let me give you an example. I have become chartered accountant now. I want to start a practice of CA, but I know that if I start practice on my own, it will take 5, 10, some number of years before I become very successful and start getting clients regularly. So what I do, I approach a senior chartered accountant who is about to retire. Retire means now because of age and health, the person is not able to attend to his or her practice. So I offer that senior chartered accountant, ki sir, ma'am, let me purchase the goodwill of your profession and I will pay you lump sum 1 CR. So simply, since you are also not able to handle your own profession because of your age or health, now make me the owner of your profession simply. So I purchase your profession, and obviously in profession, there are no major assets. The main thing in profession is the goodwill, because that person in past 25, 30 years of practice has created a name of his or her firm, because of which now clients are coming regularly. So I will get that set practice for which I am paying 1 crore rupees as goodwill. Now this is example of purchase goodwill. So let us say I purchase this practice today and I pay 1 crore as goodwill. Now goodwill we all know is an intangible asset. What is the cost of acquisition? It is this actual cost 1 crore. Now from today, I start running this practice. Now whatever were my number of clients today, let us say there were 500 files, 500 clients today. After 10 years, this 500 becomes 700. Now definitely whatever is the increase in the number of the clients, which in other words is the increase in my goodwill, is now because of my efforts, which you can also call as cost of improvement. This improvement has happened self-generated wise. Means what? I cannot again purchase goodwill and add it. It will be self-generated. So what is the logic of this point? That whenever in case of intangible assets, you will see improvement, that is increase in the goodwill, increase in this, that will always be by self-generation. So once you have purchased the asset, later on whatever goodwill you are increasing, that is automatically adding. So that is self-generated. Now since this goodwill is self-generated, it is adding automatically. That is why the lawmakers have said that we have already made a rule, self-generated intangible assets cost is nil, and improvement in case of intangible asset will only happen by self-generation. So let us take it as nil. So I'm giving you the logic why it is to be taken as nil. Now coming to the next point. The next point is tangible assets like this building. So building is a tangible asset. Now what they are saying, in case of tangible asset, whatever is the improvement done before 1st April 2001, that you will take it as nil. Now this logic we don't understand. So for this, let me give you an example. You purchase these 3 floors. So the original building was of 3 floors. You purchased this in 1994. Correct? Then the 4th floor you constructed in 1998. And the 5th floor you constructed in 2007. Okay? So original building of 3 floors, you purchased 1994. You have some cost of acquisition. After purchase, 4 years after that, you constructed the 4th floor, which is in 1998. And then the 5th floor, you constructed in 2007. Now, in this particular case, when you are going to compute the capital gain of this building, so you have sold the entire building, which is of 5 crores, 5 floors, sorry. So FVC is of 5 floors, no problem. Now see, I'm not writing the value, I'm giving you the logic. Now you have to subtract cost of acquisition, you have to subtract cost of improvement. Now they are saying, while taking cost of improvement, whatever you have done before 1st April, you will ignore that, you will take it as nil. So in other words, they are only asking me to take the 5th floor's cost here. However, I have done improvement by adding 2 floors, 4th and 5th. But they are saying don't take 4th floor cost here. Take only the 5th floor cost. Why not 4th floor? Because 4th floor was added before 1st April 2001. That we have made a rule, you cannot add. So ignore that. Now you'll say, sir, what is the logic of this? The logic is this. And for this, again, let me take you to the main point. This rule. Now, because of this rule, what would have happened? Same example. 3 floors are cost of acquisition. and this fourth floor is the improvement. Now these three floors 1994, this fourth floor 1998. Anyways, fifth floor has not happened up to 2001, so I'm not drawing it here. Now understand this. All this has happened before 2001. Now, when you are taking the cost of acquisition over here or here, because it is building, you will take the lower one. You are comparing actual cost with the FMV or stamp duty value, whatever. But all these values are taken off 2001. So when you are taking the value of this building on 2001, the building is of 4 floors. It means automatically your value as on 2001 is already of entire building, which is 4 floors, which includes the fourth floor, which is the improvement floor. So whenever you will be applying this rule for finding out cost of acquisition, so the cost of acquisition will always be of 4 floors. Why? Because this fourth floor, which you have added later, is already covered in cost of acquisition because of the 2001 rule. And since it is already covered here, hence, again covering the cost here will be double deduction. So they are saying for tangible assets, whatever improvement done before 2001, ignore. Why to ignore? Logic is because it is already covered in cost of acquisition. See, so minutely they have thought and designed this. Understood by all? Clear to all? Arun, it will be nil. You again have raised a very good question. It will be nil. Why? Because the law does not allows you to take self-generation. So in case of self-generation, it has to be nil. But a good question. Students, is this point clear? So see, if you only read the bare provisions, like here, when you start reading this cost of improvement, they are suddenly saying for intangible assets, cost of improvement is nil. Then they are suddenly saying for capital asset, which is acquired before 2001, whatever improvement you have done before 2001, the cost of improvement will be nil, right? Now, suddenly, when you understand cost of improvement and they suddenly say that, okay, take cost of improvement as nil for assets which is acquired before 2001, we suddenly get confused. We feel that, oh, the section is very confusing because now we'll have to learn one more point. See, when students find it difficult or confusing, when they have too many things to learn. But if you understand the logic of the provision, which I just explained here in the form of this simple diagram, you'll understand why only fifth floor's cost is taken. Why fourth floor cost is said to be nil? Because it is already covered in cost of acquisition. Understood, students? Clear na? Pakka? Sridhar, beta, I just explained na fourth floor cost. When you are comparing the actual cost and FMV, FMV will be of 4 floors na, because when you are finding out FMV of building on 1st April 2001, it is already having 4 floors. Correct? Sridhar, I hope you got this. So by default in cost of acquisition, your fourth floor cost will get covered, and that is why it is to be ignored in cost of improvement. Right? Now coming to another case, which is of depreciable asset. Now, if you remember, students, we had covered this in PGBP depreciation sums. If you remember in PGBP depreciation sums, we even computed capital gain on depreciable asset. And over there, if you remember, we decided that either it will be depreciation or either it will be capital gain or loss. Now, when you will take depreciation and when you will take capital gain or loss. So for that, if you remember, we had found out two scenarios. What are those scenarios? Where the entire block becomes empty, which the loss is block ceases to exist. or block becomes empty. Now, when block becomes empty, when all assets are sold. Correct? Or our second scenario was, if you remember, where maybe there are few assets, but the WDV of the block becomes nil. You remember that? So WDV becomes nil. That is the second scenario, right? Even if you don't recall, don't worry. I'll take you back to the depreciation sums for revision. But here right now, I'm just writing it so that we need not again spend time. I had said this at the time of PGBP itself, that we are understanding it here itself. So again, you will not be required to revisit it and again solve it in the chapter of capital gains. So what are the two scenarios in which in case of block of assets, you will compute capital gain? One, when the WDV of the block becomes nil, or when all assets in the block are sold. Most important point is as per section 50. As per section 50, whenever you compute capital gains, the capital gain on depreciable asset will always be treated as short term. So this is what is given over here. Section 50 has overriding effect on 242A. What is 242A? If you remember, it is the definition of capital asset where we were given the 12 months and 24 months rule. However, section 50, which deals with depreciable asset, is having overriding effect, which says that whenever you are transferring a depreciable asset, whatever gain or loss you will get will always be deemed to be short term. And this is what I have written as an exception to the definition of long term short term assets, that is 12 months 24 months rule. So whatever gain or loss you get, that is only short term gain or short term loss. That is what the law says. So you will never have long-term capital gain or loss arising from transfer of depreciable asset. And then comes cost of acquisition of power sector units. Again, recall depreciation chapter. Power sector units are the only units or the only assessees who are given the option to calculate depreciation by the SLM method. If you remember, all others are only required to calculate depreciation by the block method. Power units are given an option, either block method or SLM method. And the most important point, they have to decide that in the first year. After that, they cannot change the method anytime. Now, let us say the power units have decided to compute their depreciation by the block method. Now, if they are following the block method, they will cover in 50. That is, they will follow the same block method rule and they will get capital gain or loss in two scenarios. One, when the block WDV is nil, or when all the assets in the block are sold, that is, the block ceases to exist. But what if they have adopted the option of straight line, which is given under 3211? Now, if they have adopted the option of straight line, in that particular case, they are not covered in section 50, then for them, section 50A is made. So what it says, with respect to power units, in case of depreciable assets referred to in this, yeah, sorry. So with respect to power units, in case of depreciable asset referred to in 3211, what is this 3211? SLM method. So they have adopted the SLM method, the provisions of 40 and 49. 48, 49 is what we are studying, capital gain computation. The entire computation format is given in 48, 49. Shall apply subject to the modification that WDV of the asset as defined in 43.6 shall be taken as the cost of acquisition. So what it says in simple words, in case of power units who are following SLM method, we will find out the capital gains of these power units by taking the WDV of the asset as the cost of acquisition. And logical, now see again, this is logical. Even if you are finding this technical, the simple logic is if they have claimed depreciation on any asset, now what will be the cost while deciding capital gain or loss? It will be the WDV. So for power units having option of SLM, taking option of SLM, the capital gain is computed as per 50A. 50AA, this we have already studied at the start. What is 50AA? That in case of some specific assets, like some specified mutual fund units which are purchased after this date, market linked debentures and unlisted bond or unlisted debentures, whatever gain or loss you will get on their maturity, or if you are redeeming them, whatever gain loss you will get, that gain loss will always be considered as short term. And again, 50AA has overriding effect on the definition of short term capital asset, because over there, the short term capital asset is defined as basis the period of holding of 12 months, 24 months. But this point says it has overriding effect, means what? Whenever you will sell these assets, you will not check the period of holding. Why? Because the profit loss arising on these shares will always be deemed to be short term, right? Now, how capital gains will be computed? The answer is simple. Full value will be what? On maturity or redemption, whatever consideration you have received, that will be full value, minus what will be cost? The cost of acquisition will simply be the amount which you have spent for the purpose of purchase. So that will be your cost of acquisition, and subtracting this consideration with the cost of acquisition, the difference will be your capital gain. Now, these are securities and we have studied this. If you are transferring them through stock exchange, you may have to pay STT. If you have paid STT, you cannot deduct STT. So STT deduction is not allowed. So these are also securities like debenture bonds. If STT is paid, you will not deduct them, right? Then comes another special scenario, that is slump sale. What is slump sale? See, I'll change the word to make you understand. Slump sale is lump sum sale. What is lump sum? Many times what happens, you sell your entire business as it is. I will say, sir, what is business as it is? I'll explain. So let us say you are running a factory. The factory which is manufacturing steel products. Now you have a big unit setup where you have all the huge machines and all different assets, plant machinery, furniture, so many things in the unit. Plus you have your administrative building, you have your sales department. This whole is your business. Now, when you are running a business, you have multiple assets, land, building, plant machinery, furniture, and also for running the business, you may have some liabilities which are outstanding, like your creditors, your loans, everything. Now, what happens is you do not want to continue to run this business. First option is you close this business and sell the assets. But as you all know, many times this may be loss making to you. Instead, you look out for someone who want to do the same business. Now, let us say you get connected with me and I say, yes, I wish to run the same business of steel manufacturing. And for me, starting a new business, setting up a new business may be difficult. So I also am benefited. You're already having the entire setup. I just take up your running business, which we call as going concern. So instead of you closing the business and selling the assets, what understanding we have made, I will purchase your entire business as it is. This is what is selling or purchasing business as it is. As it is means running business, which we call as going concern. Now, in some such cases, We discuss on what will be the price. Now, since I'm buying the whole business, I have fixed a lump sum price. That is why I said read slum sale as lump sum. So you'll understand and remember. So what is the lump sum price I have fixed? 500 crores. Now, when I fix a lump sum price, what is my logic of calculating this price? I would have found out your net worth or net assets. How I would have done that? I would have taken the total of all assets, subtracted your liabilities, whatever you are having for outsiders. This is your net asset or net worth. Correct. This is what I would have assessed. Also, since this is a going business, I would have taken some goodwill. And this is how I would have derived the 500 crore figure, which is the lump sum price. So we agree at this price. You sell your entire business as it is, as going concern to me, and I pay you 500. This is what is slum sale. Now, when it is a slum sale, when you have sold the entire business as it is, and most important, for a lump sum price. Acha, it is not necessary that in slum sale the whole business is sold. If you are having multiple units, you could have sold me one of the units. So slum sale may be transfer of either whole business or one of the units. So it is both. Most important is it is at lump sum price, that is without assigning value to individual assets and liabilities. That is how I said we arrived this figure of 500 means we have done the deal at a lump sum price. When we were sitting across the table to finalize, you said 1000 crores, I said 200 crores, and somewhere we decided 500 crores. Lump sum, without fixing how much for land, how much for building, lump sum. Now, when you have received the consideration lump sum, now the challenge comes. Now, please understand, see, calculations are very simple in capital gain. Only every section gives you something different, so you get confused or you feel it is very technical or very difficult. No, understand the logic. Now, what is the challenge? Why this has been made as a separate section? Because in case of slum sale, you have received a lump sum price, and that is covering all assets and even covering liabilities. So assets minus liabilities, this is how you have received 500 crores. So you have given away everything at one shot, and I've given you a lump sum amount of 500. Now, had it been a different way, what is a different way? You're not selling your business lump sum. You are selling each asset separately. Land you have sold for 100 crores, building you have sold for 50 crores. Then you could have calculated capital gain separately for each thing. Land, 100 crore is full value minus cost of acquisition, whatever is the cost. Building, 50 crore is full value minus cost of acquisition, whatever is the cost, and so on. But that is not happening here. You are giving me your entire business, either the whole business or one or two units of your business. But whatever units are giving, that is given lump sum. Lump sum means everything in the unit, asset, liability, everything you have given. And I have given you a lump sum price. Here, what is the challenge? The challenge is you have given me everything as one package. So I have also received the land, the building, all the assets, plus I have also received the liability, and net I have paid you 500. Please focus on this word net, because I am also taking your liabilities. Now in this case, how will you compute your capital gain on land? Not possible, because you don't know how much I have paid you for land. You cannot compute your capital gain on building, because you do not know how much I have paid you for building, because I have given you lump sum. Please understand the challenge. So the law says, no problem. Since your deal is lump sum, we will also compute the capital gain lump sum, that is on the whole undertaking, whole business which is sold. Normally, we compute the capital gain on one asset, for land, for building, for shares. Here, it is not possible because everything is given as one package. So let me compute your capital gain lump sum. How? So this section 50B applies. It says full value is this 500 crore. What is that 500 crore? The lump sum price. Now comes the main point for this 50B is made, or cost of acquisition. What they say, cost of acquisition is the net worth, net assets. How do you find net worth, net assets? Go to your books, take the value of all the assets, subtract the value of all the outside liabilities. The difference is net worth, net assets. This is your cost of acquisition. So what is the special point in this 50B is only one thing, that in such cases, we take the cost of acquisition as the net worth. Now subtracting this, whatever is the difference will be either capital gain or loss depending upon whether I have paid you more or less. Now comes the next question, how to decide long-term, short-term. Now, interestingly, for long-term, short-term, we have seen period of holding. Now, again, this is the challenge. There are different period of holdings, like for shares and all, it is 12 months. For land and building, it is 24 months. For machinery, it is 24 months. But you have given everything lump sum. Maybe then if you have those market linked debentures, it is not having any period of holding because it is in exception rule. But here you have given lump sum. So how do you decide the period of holding and how do you decide long-term, short-term? Again, they say, don't see the period of holding of land or of building or of shares. Why? Because we are not computing capital gain on individual asset. We are computing capital gain of the business which is transferred. So find out the period of holding of that business. If the business was held by you for more than 36 months, we will treat it as long-term. Otherwise, it will be treated as short-term. So this is where this particular entire 50B becomes a separate code. Separate code means again a separate case of computing capital gain where entire business is sold for a lump sum price. They say don't compute capital gain asset wise because that is not possible. Compute it business wise where the full value is the lump sum price. Cost, you know your balance sheet, take all assets value, subtract all liabilities value, get the net worth, that is your cost of acquisition. And for deciding long term, short term, you take the period for which the business was run by you. Now, here comes that point which I was explaining from day one. When you see the general rule for period of holding and the short term definition over there, it is now 12 months, 24 months. Earlier, there was 36, which is removed. When you come to 50B, where they have again repeated the same point only for slum sale, I believe, at least this is my understanding, that the lawmaker forgot to make that amendment here to change this 36 months to 24 months. So here it has remained 36. So presently we are studying it as an exceptional case that for slum sale, for deciding long term, short term, you still follow the old rule, which is 36 months. So where the business is held for more than 36 months, you'll call the capital gain over here as long term. If the business is held for 36 months or less, you will call this capital gain as short term. Students, I hope you understood this case also. Mehak beta, slum sale means, see, understand this. I'll give you another example. Chalo, you may not have seen business. So let us say right now you are having your house where you stay. Now you want to change the house, right? Now, whenever you want to change the house, what is the common thing you will do? You will sell off this old house so that you can use the money in the new house. But within your house, one is the flat, which is the land building. Then you have ACs, you have kitchen equipments, you have sofa set, etc., furniture, you have television, so many electronic gadgets. Now, one thing is what you can do is you can sell some of these assets, some you may shift to the new house. Or many times what people do, ki chalo, I want to do everything new in the new house. What I will do, I will sell everything, this entire furnished flat, we call it as furnished flat, for a lump sum price. Now let us say that lump sum price you have decided for your flat as 2 crores. Now in this 2 crores, you are considering the flat, that is the land building also, plus you are considering the utensils, the TV set, the ACs, everything you have considered for one lump sum price. This is beta what is meant by slump sale. Actually, slum sale concept is for business, but I'm explaining it to you with a very practical, simple example of your house. So here, when everything in the house is sold for a lump sum price without giving independent values, that is what is slum sale. Arun beta, so this is what we are trying to say. Your assets may include depreciation asset, but you are saying all assets are depreciation asset. How? Is your land depreciation asset? No. Are your shares depreciation asset? No. Then how can you say, Arun, everything is depreciation asset? Right? Na? So Arun, that is why they have said that for deciding long-term, short-term, we will see the period of holding of the business. If you are running the business for more than 36 months, we will call this capital gain as long-term. If you are running the business for 36 months or less, we'll call it as short-term. Why? Because you're not only having depreciation asset. Please understand this. Depreciable asset are only furniture, plant and machinery and building. You may have land, which is normally there, not may. You will be having land. You will be having shares. So these are non depreciable assets. Plus, what about the liabilities? We have also taken the liabilities. Now, for liabilities, there is no period of holding around. So you cannot conclude that it should be treated as short term. Also, the section which you are mentioning is wrong. For a depreciable asset, the section is 50. 50 AA is only for three assets. If I'm not wrong, last time also when I was explaining the exceptions, you had mentioned 50 AA for depreciable asset. No, for depreciable asset, the exception which is given is under section 50 bracket 1 and 2. And for three assets, some specified mutual funds purchased after 1st April 23, market linked debentures and unlisted bonds and debentures. For them, it is 50 AA. Yes, Harshal, you're right. Yes, Ramakrishna.
Sir, actually, we have a practical case, sir.
Your voice is not audible, Ramakrishna.
I have a practical case, sir, here in slum sale.
See, Ramakrishna, I will be happy to answer, provided it is not going beyond our syllabus, right?
Yes, sir.
So
Yes,
please,
sir. So
yeah.
only thing is, sir, here we said cost of acquisition minus full value consideration minus cost of acquisition. Cost of acquisition is the net worth. Okay, that I
Right.
understood. But based on only we did. But what happened? The income tax is saying you resist because that property, land and building we have resisted actually. So stamp duty value they consider that is the time it is a high value. So suppose for example 5 crores we sold one slum sale together all the assets, but stamp duty value it is coming to 16 crore example. So they consider as per stamp duty value it is 16 crore. So it is a net worth minus. So they arrived the capital gain. Actually instead of it is a loss only. Capital gain full value consideration is 5 crore minus net worth. So my net worth is 8 crores actually. So we sold at one amount 5
I
crores. So
understood, Beta. What is your question? Come to your question.
question is whether in that case stamp duty value why they consider here. That is my question, sir.
Because we are going to now study after this, I'm going to take you to the sections on. Now, see, till date, we were dealing in detail provisions relating to cost of acquisition, cost of improvement, right? All this is on cost of acquisition and improvement. Now we will study full value of consideration. And in that, if you remember PGBP, for land building, there is a rule given that you have to compare it with stamp duty value, right?
Before
You
agreement,
remember PGBP, section 43 CA?
yes, sir. Before agreement, after agreement, advance given.
Correct. That same point is also, in fact, in PGP, I had also mentioned that you will study the same point in capital gain. So because of that rule, now see, understand one thing. This is what is the thought process of income tax department. But this case, when it will go to the court will first check, are you falling in 50B? If yes, the court will not agree to that particular stand. They will take this rule only, that is your 5 crore. So you'll have to
Yes.
fight this case in the court. Fine,
Okay,
Beda?
sir. Right, sir. Right.
Yes, Sridhar.
Sir, in a lump sum case, land and building is then cost
Sorry, in a lump
is
sum case, land and building.
land and building is sold and cost of inflation is also taken the deducted.
Sorry, I'm not able to hear. Land and building is sold after this. What did you say?
Land and building sold, then cost of acquisition price is deducted at the time of sold.
What are you saying? I'm not getting cost of acquisition. What?
Cost of acquisition is deducted, no sir.
No, you are talking about slum sale or normal case of land building sale.
Lump sum sale.
So in lump sum sale, what we are going to do, we are going to subtract net worth. How do you find net worth? You'll take the total value of all the assets which is appearing in your books. From that, you will subtract the liabilities appearing in your books. That is how you get net worth. Now tell me, what is your question?
Sir, if asset are sold in a separately, then
So better then
cost
it
of
will not be
acquisition
slum
is
sale,
less.
na? See, what is our first point? We have to first decide, are you fitting in 50B? When you fit in 50B, two conditions. You should have sold a whole business, that is assets and liabilities both, and that is sold without assigning separate values. Are you getting this? If you
Yes,
are
sir.
selling it separately, then it is not slum sale, then it is normal sale. Then you will apply the full value of land and building, and you will subtract the cost of acquisition of land and building separately. Then you will do calculation for each asset separately. Then you will not fall in 50B.
Okay, sir.
Correct?
Thank you.
See, all these are special cases, and you have to first check whether you are fitting in the special case. Then only you will apply this provision. Otherwise, you will calculate the capital gain normally, what we are going to now start solving after this. Yes, Arun.
Sir, sir, we discussed the 1st April 2001 rule applicable, which are you going to consider cost of the acquisition of the fair value which was higher. Sir, is this applicable for a business as also?
See, understand one thing, Arun. I think you want to ask whether this applicable to slum sale or not.
No, sir, business.
What do you mean by business?
Sir, if they purchase any land or asset before means assume that
I understood that. I'm
2019.
asking what do you mean by business? You are saying whether this is applicable to business. My question is, what do you mean by business?
Sir, business means we're going to do some trade, transaction, goods
Trade of
sale,
what?
manufacture.
Trade of land building or trade of something else?
Sir, land building.
So then your head is PGBP, na?
Yes, sir.
If you are in the business of purchase sale of land building, your head is PGBP, right?
Yes.
In
Yes,
PGBP,
sir.
have we studied any such rule of 1st April 2001?
No, sir. Sir,
Simple. So
but we
that
also
means,
having some fixed asset like furniture or something. In that time, we can be do.
see, Arun, please be clear one thing. What is your business? Land building. So land building is your stock in trade.
Yes, sir.
All other assets will be capital asset because you are not
Yes.
dealing in them.
Yes, sir.
So for all other assets, you will apply capital gain provisions, which we are studying, where 1st
Yes,
April
sir.
2001 rule is applicable, where previous owner rule is applicable, all that is applicable. And for your stock in trade items, like in your example, it is land and building because you are in the business of sale of land building, right? In
Yes,
that case,
sir.
you will apply the provisions of PGBP because that is your stock in trade. And over there, you do not have these concepts of 1st April 2001. Over there, you do not have the concept of indexation. Are you getting my point?
Yes, sir.
Is your question answered?
Yes, sir.
Great. So students, here we have completed up to this part. Now we'll take a break. After the break, I'll explain you some special cases relating to full value of consideration, which is given at the start of our module. And then we will go to practical sums. In the meantime, you please download the practical sums, which I have uploaded yesterday as assignment. The date mark for it is today's date. That is for which lecture that assignment is applicable. It is today's assignment. So you can please keep those questions handy so that after the class, when we start this, that is computation of capital gain, that will be helpful to you. This is clear to all? Fine. So let us have our break, and after break we resume and we also first study some provisions, and then we will also go to practical sums. So from today we will start our practical session and we will be in a position to find out the answer. Fine. Thank you. Let us continue. I'll just open my question set. In case if it is not available to you on BOS, you may just take a screenshot from here, no problem. Yes. Just a minute, students. Okay. So now, after discussing cost of acquisition, let me take you to full value of consideration, because that is one important component that we need for the purpose of computing our capital gain. And once we understand the full value of computation provisions, we will go back, or we will go to the computation of our practical sums. Okay. I hope everything till now is clear. No problem. If it is not yet available on the portal, maybe they are yet to verify and confirm it. No problem. You can take a screenshot from the sheet when I will be showing it on the screen. So for the time being, what is full value of consideration? As you remember, full value of consideration is nothing but the price that you receive. If it is received in money form, the money consideration. If it asset is received, the FMV of the asset received. Whatever you received against the transfer of the capital asset, that is your full value of consideration, right? Now we go to the important aspects, or you can say special situations of full value of consideration. So first is the general rule. Full value of consideration as per section 48 is the amount that you receive against the transfer of your asset, right? Now let us go to some special situations. Full value of consideration of share debentures or warrants issued under ESOPs in case of transfer under gift up to AY 24-25. Now this point you can very well ignore, students. Why? Because as you can see, this rule is applicable only if the shares or debentures which you had received originally under ESOP scheme from your employer is later on given away by you as gift. This rule has been amended from AY 24-25. Prior to this, in this particular scenario where your ESOPs were given away as gift. Now we all know giving away gift is not a transfer. However, this rule had an exception. Only one gift was transferred, that is gift of ESOPs. But today, this is also not the case. Today, all gifts that you are making are not transfer. Hence, this particular provision, since it is an old scenario, you can ignore it very well. But just for your information, when this old scenario was applicable, what is the old scenario? You have given away your shares or debentures, which were your ESOP shares or debentures, by way of gift. That was earlier considered as a transfer, not today. And at that time, for the purpose of computing capital gain, the market value on the date on which you have given gift was deemed to be your full value of consideration. So full value of consideration in this particular case was deemed to be the fair market value. But again, I'll repeat, no need to focus on this as far as exams are concerned, because in our exams, the question that you will have to deal with is of AY 26-27, right? And this is 2 years before, so you may comfortably not learn it. Again, this I am keeping aside for the time being. This was, I think, Anil's or somebody's question, sir, how to deal with security sold by non-resident. Again, see, these are those 20% cases which we are going to deal with in the next class. My first objective is to make you thorough with the 80% provision. So we are covering the 80% past part first. Again, if you remember, we have kept this one more thing aside, that is shares which you have purchased before 1st February 18 and which are sold today by paying STT. So these two things right now are kept aside. We are proceeding with the other scenarios which are applicable in every transaction, which I'm calling it as the 80% cases. Now, in the 80% cases, the next point that is covered is, okay, we have done the slump sale also. Slump sale is done. Yes. Now this is the point which I was just discussing few minutes before going into break. Now what is this point? What you have sold is land or building or both. Now students, what I'm going to explain is already taught to you in PGBP head under section 43CA. So I'm not going to explain anything new, just we are going to revise. What is this point? What you are selling is land building. Now, if you remember PGBP head, we had discussed under section 43CA that where land and building is your stock in trade, that is you are a builder, a developer, etc. Then for transactions of land building, you check or you apply 43C. But where land building is a capital asset, like for you and me, because we are not into the business of dealing in land or building, we are not developers, we are not builders. So for us, land building is a capital asset, and for us the section applicable is 50C. Now what does 50C and 43CA both says? They both say that whenever you have sold land or building, now I'm talking from the perspective of capital gain, what will be the full value of consideration? The full value of consideration will be derived by comparing your actual price, or let us call it as the agreement value, with the stamp duty value. So today I have sold my building to you. Let us say we have agreed a price of 5 crores. I will compare it with today's stamp duty value. Now here there are three possibilities. Possibility one. Option one, possibility one. Stamp duty value is lower. Now if stamp duty value is lower, then full value of consideration will be what? Full value of consideration will be your actual price, that is 5 crores. Second possibility is stamp duty value is higher, but it is slightly higher, not much higher. It is slightly higher. Now what is this slightly or much? The condition is check whether stamp duty value is higher from your agreement value beyond 110%. So whenever the stamp duty value is higher, what we do is we take 110% of this, which comes to 5.5 crores. Compare it again with stamp duty value. Now, your stamp duty value was higher than your actual price, but slightly. Slightly means not beyond 110%, because 110% is 5.5, it was only 5.15. Now, since stamp duty value is not higher beyond 110%, again, your answer is your actual price. So again, what will be your full value of consideration while computing capital gain? It will be your actual price. Please remember, this will never become your full value, neither in capital gain nor in PGBP. This 110% value is calculated only for comparison to decide whether I should take actual price or I should take stamp value. Now, if stamp value is not exceeding your actual price beyond 110%, it means the 110% is higher than the stamp value, which is the second situation. You take your actual price only as the full value. Third situation, actual price is 5 crore, stamp duty value is 6 crores. Now again, whenever stamp duty value is higher, you take 110% of your actual price, which comes to 5.5 crore. Compare it again with stamp duty value. Now, the stamp duty value is still greater even with the 110% of your price. So stamp duty value is still higher even though you have made your price 110%. Now, when stamp duty value is higher beyond 110%, now you will take stamp duty value as your full value of consideration. Correct? So this is the first point about 50C. Again, I'll repeat, we have discussed the same thing. We have rather multiple times repeated, revised it under PGBP. Only there the difference is the land building is your stock in trade. So you go to PGBP head. Land building is capital asset. You come to capital gain head. Right? Now comes an important point where FVC is stamp duty value, which will happen only in this third case. That is third case. This case. Now, when stamp duty value becomes your FVC, you are having one more provision. What is that provision? You compare this stamp duty value with valuation officer's value. So if stamp duty value is higher and it can be taken as your full value as per the provisions of 50C, the law provides you with an option that you can go to the assessing officer, your income tax officer, and request the officer to refer your case for valuation. Now, when your case is referred for valuation, you will have another value, the third value, which is the valuation officer's value. Now, this is 6 crores. Again, possibility 1, valuation officer's value is even higher. And possibility 2, valuation officer's value is lower. Two possibilities. Sorry. The second possibility is valuation officer's value is lower. Now, where valuation officer's value is higher than the stamp duty value, your final answer is the stamp duty value. But where the valuation officer's value is lower than the stamp duty value, now your final answer is valuation officer's value. So your own value, stamp value. These are the three answers. Wherever stamp value becomes value because it is higher, then you do one more comparison. Stamp value with valuation officer's value. If out of this, you have to take whichever is lower. This is the rule. So if stamp valuation officer's value is higher, you continue with the stamp value. But if valuation officer's value is lower, you take valuation officer's value. Is this clear, students? Now, there's one more point relating to this. This you will get mainly in your MCQ type of questions. So left-hand side, whatever I have shown, you will be required in the practical sums like what we are going to discuss now. But in your MCQ type of questions, which is generally a compulsory question, which is covering the entire subject, you will be given this situation. What is this situation? Now, when you have to find out the value, left-hand side of your screen, you have to always compare the value with stamp duty value. Now, the question is stamp duty value of which date is to be taken. Now, this question will become important where there are two dates. What are those two dates? date of agreement and date of registering documents. Now, what are these two dates? Date of agreement means you come to me today. Today we fix up that yes, you want to buy my property and you give me a token. So today we have agreed you will purchase my property. But today the deal is not completed. Entire transaction is not closed. Most importantly, documents are not made today. Why? Because you want some time to arrange the money. Also, we need to complete all the formalities like putting some advertisement in newspaper. There are so many formalities when you are transferring a property. For this, we require 3 months time. So the second date is the date when all formalities are completed and you finally register the document. Because in all immovable property transaction, you have to go and register the sale deed with the authorities. Now, between this date, if the stamp value has changed, which date stamp value is to be taken? The law says take the old stamp value, that is on which you had agreed. That date stamp value will be taken. But for this, you'll have to first prove that actually on this date your agreement happened. Now, how will you prove? Because on this date, no documents are registered, the actual transfer is happening at a later date. So on this date, you should be able to prove that yes, we had agreed. Where or how? When you prove that any part of your consideration, which you can call it as advance or token. So normally whenever we finalize a deal, we take some token or advance. So the token or advance, which is some part of your consideration, was paid by the approved mediums, which is account paid check or account paid draft or ECS or through any prescribed online mediums. So if the transaction was done in a manner that this token advance was paid using a prescribed medium, then the government will say that, okay, for the purpose of applying this section, we will take the old stamp value. If not, even though you had done agreement earlier, but the token advance was paid in cash by bearer check, we will go by the new stamp value and we will do all these comparisons which you see on the left hand side by taking the stamp value of the new date. And that will always be disadvantageous to the taxpayer because generally stamp value is always increasing. So a higher stamp value will be taken for comparison, and then there is a possibility that you end up paying more tax. So students, this is entire 50C. It is more like a revision we did. Now we'll also apply this in the form of practical sums. So this point is about that valuation officer's case, which value will be taken. Now, another special case of full value is unquoted shares. Now, what are unquoted shares? Unquoted, you can also call it as unlisted. Now, where unlisted shares are sold, the law says the full value will be either your actual price or the FMV of such shares, whichever is higher. So out of both, you have to take whichever is higher. So this rule of taking FMV or your actual price, whichever is higher, applies only in one case, students, that is unlisted shares, unquoted shares. Next scenario of full value is, which is applicable to all capital assets. What it says, wherever the consideration is received on account of transfer is not ascertainable. You cannot find out how much consideration is received. Why? Either because proper records are not available or because the consideration is received in non-monetary form and it is received in such a form for which valuation cannot be done. Now, whenever the consideration is received in any such manner which cannot be ascertained, cannot be determined, the law says no problem, we will take the FMV of the asset as our answer. So what will be full value? full value will be FMV on the asset. But again, students, please remember these two cases are very specific, where they are asking you to take FMV as the full value. First is in case of unlisted shares, actual price compared with FMV, whichever is higher. This rule is there. Secondly, taking FMV as the value, full value is applicable only if actual price, actual consideration is not ascertainable. Fine, students. Now, with this, we have completed all the cases which are necessary for doing computation of 80% case. Yes, I again repeat, few special cases are left out, but that will be done in the next class. Now, we have to understand how to find out capital gain in regular cases. So I've taken some examples. Take a screenshot of this so that even if I'm changing the screen, I'm going to some other screen, it will be easy for you to correlate. Done. Taken screenshot of first 9 sums. Chalo. Now we'll go to computation of capital gains in different situations covering the provisions that we have studied. Now, students, I'll give you a sequence. Follow that sequence, you will never be wrong. First, check, do you have a capital asset? Then check, is the capital asset transferred? Now, maybe one of these two tests itself will fail. If any of these tests fail, your answer will be a sentence. No capital gain is applicable in this case because capital asset is not there, or whatever item is not a capital asset, or because it is not a transfer. And you have to just explain why you feel it is not a capital asset or not a transfer. You get the 3 to 4 marks assigned. But if both things are present, then you will proceed further for computation. Now in computation, first check, is it exempt under section 10? Now we have not yet studied, but don't worry, it is only 2 cases and none of these cases cover them. So it is also not exempt in section 10. Then you'll go to computation. In computation, we'll decide in which year it has to be made taxable. So year of chargeability. And after you have decided that, okay, it is taxable in the previous year, 25-26, now you start computation by determining full value of consideration, expenses on transfer, cost of acquisition, cost of improvement. Indexation we will not do. Please remember, it is not applicable to us. Indexation. Keep this in mind. You are not required to do indexation. Keep this in mind. That you will be doing only in one case. That also not now, not in this chapter, but in the chapter where you go for computation. So indexation not applicable. So find out full value, find out expenses on transfer, cost of acquisition, cost of improvement. While finding out all this, you have to apply the provisions which we just studied, and it is through. Now, what is given? Mr. Namo sold land for 110, stamp value 1.12 on this date. Commission given to the agent is this. The land was purchased by him on this. Compute capital. Now, step by step. What is sold? Is it a capital asset? So land is a capital asset. The only exception could be if it would have been the stock in trade. Then it would not have been a capital asset. But here that is not the case. So we cross the first barrier. What have you done? Have you transferred? Yes, I have sold the land. Sale is transfer. There is no exemption to this under section 10. Now you have to determine the year of chargeability. So when we solve some students, our solving and your answer presentation, the first thing that will be required is determining year of chargeability. So I'll show you the format in which you will be solving the sums. So computation of capital gain. Now, either this may be your main answer or it may be a working note of the main answer. So when the main answer is about the total computation of income or tax liability, this same thing would be working note. Now, the first thing that you have to write in particulars is year of transfer. First thing you have to decide is year of transfer. Now, in the first case, what we are dealing with, what is the year of transfer? Now, what rule, students, we have studied? What is the year of transfer? Year of transfer is, sorry, the year of chargeability is the year of transfer. Now, what is the year of transfer in this particular case? In this particular case, case number 1, the year of transfer is financial year 25-26, correct? So my year of chargeability, if I'm writing the previous year, will be 25-26. Now let me tell you, in 99% sums, it will be 25-26 only. But still, you have to mention this in the exams because it carries marks. So this is your presentation. So in particular, the first thing you have to decide is year of chargeability, which as per the provisions we have studied is year of transfer. Now full value. Now for this, there is a working, not working exactly, but a note that you have to write. So I'll just put down all the values first. Expenses on transfer. This is net consideration. Then minus cost of acquisition, cost of improvement, and then capital gain, capital loss, long-term, short-term, all things we will write. Now, most important, students, is your notes. Correct? Now, what is full value? Full value, students, in very simple words, is your sale price. So it is the price at which you have transferred your capital asset. Now, in this particular case, what is the price at which you have transferred the capital asset? 1 crore 10 lakhs. However, since this asset is land or building, we just studied in section 50C that for land building, you have to compare it with stamp value. And we just studied that you have to compare it with stamp value. And if the stamp value is greater, which is our second and third case, you have to find out 110% of your actual consideration. Again, compare it with stamp value. Now, either your 110% is higher or still the stamp value is higher. If your 110% is higher, your actual price will become the full value. If still stamp duty value is higher, even higher than the 110%, then your stamp duty value will be the answer. So 110 is our price, actual price. Now I'll have to find out 120%. Note 1. As per 50C, sorry, I should say section. If stamp duty value is higher than actual consideration, we shall compare 110% of actual consideration. Now here, our price is 1.1 crore into 110%. It is 1.21 crore. So we compare 110% with our stamp duty value, which is given as 1.2 crore. Now, as per 50C, if stamp duty value is smaller than the 110% of actual consideration, and now why I'm writing this option of smaller, because in our case it is smaller, it is 1.2 and this is 1.21. So stamp duty value is smaller than our actual considerations 110%. So in this case, what does 50C says? So as per 50C, if stamp duty value is smaller than this, then FVC is actual consideration, that is rupees 1.1 crore. So students, you will have to write it like this. Only then you will get complete marks. Right? Hope this is clear, understood by all. Now, what is the next thing that we require? We require expenses. Now, have you incurred any expenses here for transferring the asset? Yes, I had put an agent. To the agent, I got this particular deal, I got this customer, and I could sell my asset. So whatever is the agent's commission, that becomes my expenses on transfer. Yes, Anshul, correct. So in my expenses on transfer, I have to take the agent's commission, right? Which is 30,000 in this case. So I'll subtract. Now 1 crore 10 lakhs minus 30,000 is 1 crore 9 lakhs 17,000. Now cost of acquisition. Now you go to the cost of acquisition provision. What is the rule? Cost of acquisition is your actual cost. Now in this, we have two important rules which you have to always check. One, previous owner rule. Second, 1st April 2001 rule. Now when you check, when you apply the 2001 rule, if the asset was purchased before 2001. Now our asset is purchased in 2018, so 2001 rule is not applicable. When you apply the previous owner rule, when your asset was purchased by previous owner and given to you as gift, will, transfer, succession, inheritance, that is not transfer. In those cases, you will apply the previous owner rule. Now, fortunately, in this, none of those cases are applicable. So our cost of acquisition is as per the normal provisions. No special provision is there. So cost of acquisition is 40 lakhs. In this sum, there is no improvement cost. So finally, you get your answer. Your answer is 6970. Now, whether this is long term, whether this is short term. So for this, apply the short term capital asset definition. It says 12 months, 24 months. Now, since this is land, which rule is applicable for determining long term, short term? Achha, somebody saying commission is 3 lakhs. Okay, I'll correct it. No problem. In the meantime, tell me, student, what is the rule for long term, short term, which will apply here? Now, I want answer with respect to this sum. So for long term, short term, what will you apply here? Very good. So what rule applies? The rule applies is 24 months rule. Now we have to find out whether our case is long term or short term. So we will check what is the period of holding. So period of holding starts from here to one date before the date of transfer. So it will be up to 4/10/25. We count period of holding from the date of transfer to the date 1 day prior to the date of transfer. Now, is this period exceeding 24 months? Yes, 2018 to 25 itself is around 7 years. So this is more than 24 months. So finally, my answer will be that this is long-term capital gain. Right, students? See, the calculations are simple. Only for every step, check the provisions, check capital asset, check transfer, check full value, cost. So you'll find that as we proceed with these sums, one by one, I have added one adjustment for your better understanding and clarity. Now, the second question, what would be your answer if he had purchased the land on 10/10/23? So everything else I have kept same. Now nothing has changed. So my answer in question 2 up to here is same. Why? Because I have not changed any facts and figures. Yes, I've changed one fact, but the figures are all same. Now the only difference which would happen in this case is, now I'm saying my date of purchase is this date. I have again count my period of holding from this date up to this date. Now 10-10-23 and 4-10-25, it is less than 24 months, just slightly less than 24 months. Now when I counted my period of holding in the previous case, that is question 1, it was more than 24 months. So it was long term. Here it is just slightly less than 24 months. So the amount remaining same. The only difference is that my capital gain will be short term. Students, have you understood this? Please confirm if you have understood or not. Yes, students, all clear? Please confirm. Please give your reactions. Yes, no, confusing, understood, challenging, easy, whatever. Super. Then let me proceed to the next question. Now, in this question, what we are saying, Mrs. Pooja sold gold. So the asset we have to test is gold. Then the dates are given. Step by step, what is the step I have given you? First check, is gold capital asset? And whatever you have done, is it transfer? So, is gold a capital asset? Yes. Is it falling in any exception? No, because neither you are in jewelry business, so it is not your stock in trade. And here the second exception also will test, that is personal effect. So anyways, raw gold is not a personal effect because it cannot be used for personal use. And even if this would have been jewelry, still it would not have come in the exception. It would still have been capital asset because it has been specifically treated as capital asset, right? So final answer is gold is a capital asset. Now what you have done, you have sold the gold. Is selling transfer? Yes. Is it in any case of not transfer? No. So finally it is a asset and transfer. Section 10 exemption, again, I'm telling you, it is not applicable practically to all these cases. So section 10 is not there. So all things are done. Now we go to computation. In computation, the first thing you have to decide is year of chargeability. Again, the general rule applicable is year of chargeability is year of transfer. And what is the year of transfer? It is again 25-26. So first thing I will write, year of chargeability. Now for full value, now I'll go to the further details. She has sold it for 75 lakhs. She had purchased it for 45 lakhs. Now what is full value? Full value in simple words is your price at which it is sold. Now whenever you are selling something, whatever you receive in return is your full value. Yes, there are some exceptional cases like land building sale, unquoted shares, or assets for which full value is not known. Is our case falling in any of these? No. So for us, the normal rule of full value applies. That is our sale price. And what will be the cost? The cost is again as per the rule, purchase cost. Now again, there are special cases, previous owner 2001. None of this is applicable over here. So my sale value is my full value. My purchase value is my cost of acquisition. There is no improvement. There is no expenses. 30 lakhs. Now, asset long-term, short-term. So we have to again check with the period of holding. Which period of holding applies? 12 months, 24 months. Which period of holding rule applies? 12 months, 24 months. Very good. Yes. So it is the 24 months rule. Now check 15th Feb 12 to 25th July 25. It is very much crossing. 24 months. So this is long-term capital gain. Now see here, there are no special provisions applicable. So nothing much to be written in notes. Maximum in note you'll write that gold is a capital asset and hence the transfer leads to capital gain. That also is not compulsory, but like how you are thinking, we are testing each and every point. You can write it in the same fashion. Main working notes that you have to write, or the notes that you write, is of the special cases or what I am calling as exceptions. Okay? Now moving ahead. Now Mr. Shiv sold unlisted shares. Now the moment you read this, something should trigger to your mind because we have studied something special for this. Firstly, are unlisted shares capital asset? Yes. Is it falling in any exception? Answer is no. Why no? Because I am not dealer in shares, so this is not my stock and trade. Shares are not personal effects. So all this is leading to the conclusion it is transfer. I have sold it. Whether selling of shares is transfer? Yes. Is it falling in any no transfer? No. Section 10 not applicable. So we come to computation. In computation, first is year of chargeability. It is year of transfer. In which year I have transferred? I have transferred in financial year 25-26. So my year of chargeability is previous year 25-26. Now comes the full value. This is where we just studied something special. If you remember that full value provisions have three things special, in which one of the things is unlisted shares. For unlisted shares, the full value will be the actual price received or the FMV, whichever is higher. Now, in this particular case, how much is the price which I have received? I have received 24 lakhs. And what is the fair market value on the date of sale? It is 25 lakhs. So as per the provision which I just showed you, the answer will be 25 lakhs. And I have to write a note. Again, note, see, somebody may say that, sir, how to write notes? I don't know. See, notes is how I'm thinking, how I'm talking to the same thing, I'll write note. So as per 50 CA, in case of unlisted shares, FVC is higher of actual consideration and FMB on the date of transfer. Correct? Clear? So this is simply how you write the notes. Nothing very special in that. Now, she has paid brokerage of 50,000. So this becomes your expenses. So through some agent, she could sell these shares, and that is how you get this. Now, shares were purchased on 8th October 22. Now, if you remember, for shares, there was a special date, which was February 2018. But we are not considering that right now. Anyways, I have not explained those provisions also, that we'll deal with later on. So the special case of purchase in February before 2018, February is not applicable. So normal case. So what is your cost of acquisition? Cost of acquisition is 6 lakhs. So what will be your capital gain? Capital gain will be 1850. Now you have to decide whether it is long term, short term. So for deciding long term, short term, what you have to do, you have to check the period of holding. What period of holding applies? 12 months, 24 months? Yes, students, 12 or 24? Kambira beta, why it is falling in 50 AA? Please check if it is falling in 50 AA. 12 months, 24 months, or 50 AA. So I'm giving three options because Kambira is saying 50 AA also. 12 months, 24 months, or 50 AA. See, we just saw 50AA somewhere. Now that is what is the problem. Locating it is difficult. Just for clarity. Somebody said 50AA. Check 50AA. Is it applicable? You apply 50AA when what you have sold is specified mutual funds which were purchased after this date. Have you sold mutual fund units? No. Have you sold market linked debentures? No. And what you have sold is unlisted, but is it bond or debenture? No. So what is covered over here is only bonds and debentures, unlisted. What we have sold is neither bonds nor debentures. So this rule of 50AA is not applicable to us, correct? Now, going back to 12 months, 24 months rule. Now in 12 months, what is covered is securities listed. So share, debenture, bonds which are listed are covered. But if you have unlisted shares, unlisted debentures, unlisted bonds, they are not covered in the 12 months rule. So 12 months rule cover only listed. Now what we have sold is unlisted shares. And for that, the rule is 24 months. Correct, students? See, now all your provisions will get revised. So you'll have to now apply the provisions, check the provisions. So for us, the rule is 24 months. Now check the period from 8th October 22 to 1 day prior to this date. That is up to 8th January 2026. Now 8th October to 8th January, the period is more than 24 months. So our final answer is that this is a long-term capital gain. Perfect, students. Are you getting this? Right? So students, this is how you have to now solve sums. You have to solve sums. Up to 9. So I have already showed you up to 9 and you have clicked it. So up to 9 you have to solve, because from 10 we have special cases which I will cover in the next class and we will also solve. So up to 9 is your homework, which you have already taken a screenshot of. Out of which I have solved 4 cases. 5 you will practice as a homework, plus you will read the module, plus you will solve the sums to the stage to what we have covered the module. You can now start solving those sums also from the module. Yes, Anshul. So this is what I'm saying. The only skill, or I should say challenge in capital gain, is remembering the provisions. And that is where your continuous efforts will be important. If somebody wants, you can just take a photo of the provisions also. So I'm showing you my notes one by one page. So this is my first page. You can just click this, take a screenshot, so that now while solving, it will be easy. Okay. I'm sorry, you will have to click the first page again because I'm not able to see my whole screen. 1 second. Yes. 1 second, students. So now you can click the first page again, please. Right? After this, click the second page. 1 second, 1 second, 1 second. Yes. Click the second page. Done. Click the third page. 1 second. Yes. Click this third page. Either beta, if I zoom, then the page will be going out of your screen. So I'm keeping the size as what will fit it in the screen. Anyways, after clicking, you can always zoom it wherever required. So click this page. right? And click this last page. All these pages, students, will definitely help you in solving your sums easily. And yes, somebody said it is easy to solve with you, but that is easy because I'm immediately reminding you these sections. But when you have to do it yourself, it will take time, but that is what you have to learn. Yes, Daksha, I will be definitely uploading this, but if you can see, some provisions are yet to be studied. So that is why I've asked you to take a photo so that once I complete all the provisions in the next class, then I will upload it. I hope it is okay with you. Then Lakshmi Beta, second question, it is STCG. Second question was not LTCG, na? It is STCG, Beta. See, why LTCG? It was STCG here, if you remember. Why STCG? Because it was less than 24 months. In the second question, I had changed the date. Somebody wants me to show the fifth page again. Is this the fifth page? So you can take a photo. Yes, it is the fifth page. So somebody wanted the photo again. Please take a photo if you have missed the fifth page. Okay, students. So that is all from my side. Kindly solve my remaining 5 questions and also solve the questions from modules, the illustrations of all the points that we have covered till now. You will solve the illustrations. In the next class, we will be solving more sums with some more new and special adjustments. We'll study that and we will complete. Thank you, students. Thank you very, very much. Yes, sir. Thank you, sir. Thank you very much.